Hey everyone, welcome back to the Daily Gold Podcast. Today we're speaking with a new guest. I'm really excited to have him on. He's David McAlvany. He's the president and CEO of the McAlvany Financial Companies. David, thanks for taking the time. How are you today?
Jordan, doing great. Good to be with you.
David, let me get right to the first question, and I guess it's kind of a big picture question, but since the beginning of the financial crisis, we've kind of had this inflation-deflation debate going on for so long, and of course, Treasury bonds have performed very well, and up until the last 18 months or so, commodities have performed really well. But what's interesting to me is looking at a lot of sentiment indicators. In the last couple months, it seems like a lot of the professionals have really capitulated on their inflation investments. Obviously, at the same time, money is kind of chasing performance in the S&P, and precious metals have been weak, but and the CPI and those sorts of things have come down. But to me, it looks like we could be set up for a really amazing contrarian opportunity in the commodity realm. Would you agree with that? I mean, how do you see things evolving here?
Yeah, well, it's a fascinating time to be investing, and there's more influx today than there has been probably since the Bretton Woods dissolvement in 1971, and arguably as intriguing as the 1940s, 1950s period when that was originally put in place. You have investors today who have a hard time with uncertainty, always have, always will, but what they try to do is peg down exactly what they think an outcome is going to be and invest accordingly. So, Jordan, you mentioned inflation versus deflation. With great certainty, they want to strive towards which is it? Which is it going to be? I mean, is it going to be one or the other? How does the evidence stack up? I think, frankly, we have a both-and scenario unfolding. You've had credit market debt expand from $5 trillion to over $55 trillion over about a 25-year period. That amount of debt outstanding, yeah, some of it's going to be unwound. There is going to be something of a credit market problem. But the problem we have is seeing that you really won't have an entirely deflationary scenario. Not all asset classes in question will suffer to the same degree, if at all. And I think this is where you have to look at sort of what the antidote is. What we've seen over the last 5 years is that not only the Fed, the Bank of Japan, the ECB, the Bank of England, they've all put in motion the same kinds of policies to avert this very kind of deflationary or debt collapse, if you will, with its deflationary implications. Doing everything they can to keep that from happening. So on the one hand, you do have a specter of deflation. On the other hand, you have monetary policy measures which are not only inflationary, but even hyperinflationary. I mean, Jordan, think of it just this. Take the M2 money measurement supply. So you go above $10 trillion, but we have a broken multiplier. If the money that was out there was going through the economy on a normal basis, churning through the economy on a healthy basis, you could, just going back to 2008, 2009 levels, see about a 3 times number. $33 trillion, that's a bigger footprint, and obviously there's more of an inflationary feel in the economy if that were the case. That's what I would look at, Jordan, as a real inflationary problem in the making. We already have the liquidity, a little bit like water held behind the Hoover Dam. Liquidity exists. If there's any breach in the dam, the flow will be too great for anything and anyone downstream.
Okay, David, let me follow up on that. And how is that, the potential to go from, kind of where we are with, I think you're speaking about velocity of money there, from it being, flat or negative to rising, and then having that tremendously inflationary effect. Where do emerging markets stack up? And maybe you could talk about that in context, considering, which I think has been totally ignored by a lot of the financial press, in the last month or so, we've seen a real torrent of rate cuts. Of course, Japan has been front and center. The ECB cut rates, and I think they're laying the groundwork to do QE at some point. And then you look at, just among many nations, you have India, Brazil, Korea, Russia, all cutting rates. China is talking about possibly cutting rates. Wouldn't that also have some kind of inflationary impact?
Well, I mean, what it's an indicator of is the fact that we do have a global economy which continues to slow. Everyone wants there to be traction, everyone wants there to be recovery, and everyone is almost projecting that into reality, but it has yet to really develop. I mean, yes, indications, but keep in mind it was 2010 that we started hearing language about green shoots. And here we are 3 years later, still fumbling along. The Eurozone continues to contract. China is on the edge of recession, not as bad as Europe, but certainly not moving forward. In the U.S., even of late, industrial production, housing starts, jobless claims, we're not talking about positive factors. We're talking about things that add to what is a fairly negative picture already. You look at durable goods orders and copper just as an example. These would be things that tell you a story about real economic activity. Meanwhile, you've got the S&P motoring higher. It is not necessarily an indication of economic activity or sort of a return to well-being. So this major divergence says, as you suggested earlier, we may be setting ourselves up for some pretty significant contrarian plays. Yes, on the inflation side, but also just looking at the general equity space. How long can they hold it together? That I don't know. I mean, with funny money, things can go a lot farther than you can rationalize, and maybe that's John Maynard Keynes. We can quote him. Things can remain less rational or irrational longer than you can remain solvent. That's where we are today, and I think the contrarian stands to do very well if they can keep their wits about them.
Now, with respect to the S&P, maybe you could also talk about the corporate bond market and the junk bond market, because really when you invest in junk bonds, it's similar to investing in the S&P to some degree, and this chase for yield that we have going on, it just, we have the stock market at all-time highs, we have junk bond yields are at all-time lows. I mean, this just, as we know, is not sustainable. And so, I mean, all that money, where is that going to move to? Is it going to go to, I mean, I know it's kind of a big picture general question, but I guess I'm wondering, where do you think that money, when it comes out of those areas, is it going to go into something really safe like Treasury bonds, or is it only going to come out if these people get worried about inflation and then go into your commodities and precious metals?
I think that kind of a step sequence you're suggesting is a reasonable step sequence to treasuries out of your corporates and your junk, particularly your junk, and perhaps out of those dividend payers and things that people assumed that were safe and on a relative basis to bonds were cheap and gave you a better yield. That whole ball of wax, I think, is going to be a bit of a disappointment. So, yeah, we could see bond yields in the treasury space contract again, with the 10-year dipping below 1.5 again, as you see a rotation. But I think you're seeing money wisen up a bit. There's folks that used to, on a knee-jerk reaction, get afraid and move to T-bonds, and are now having to ask the question, but what about the solvency of the U.S.? What about their ability to pay? What about the implications to our fiscal mess in the event that you see interest rates rise? What does that mean in terms of the interest component for our national debt? 1 percentage point increase equals $165 billion in extra debt. We can handle Jordan. We can handle 1 percentage point increase. We can't handle 2 or 3 or 4. So a mild increase in interest rates would be fine. But I think that comes further down the road. If you're looking for bond market troubles, that's still sort of on the horizon. Because, as you say, there's weakness in lower credit quality. You look at junk bonds. Just a few weeks ago, we slipped below 5% on junk bonds. So you've got a 400 basis point differential between the Treasury benchmark and your junk bonds. Normally, that's 900 basis points. That's 9% to 12% difference. Essentially, you're looking at CD refugees. And then when I see CD refugees, you're dealing with folks who are living on a fixed income, used to put money into CDs at their local bank and collect 3, 4, 5, 6%. Now you can't even get 0.25%. If you tie your money up for a long period of time, maybe 1%, 1.5%. But it's embarrassing. These CD refugees have been chasing yield, as you described it, and are taking on a tremendous amount of risk. And so yes, they would move to Treasury bonds, while the old T-bill buyers are asking the longer-term questions about solvency and sort of potential for devaluation of the dollar, which could hurt really hard. Kind of the double whammy of interest rate risk and devaluation at the same time.
Is the real end game to this, financial crisis or secular bear market? Is it when we see long-term interest rates globally start to creep higher, and then central banks, they can't pressure them downwards anymore, or is it going to be something else?
I don't think you're going to get the real story in the interest rate market. You look at Spain and Italy today, and it's not a reflection of reality. The 10-year in Spain and the 10-year Treasury in Italy, are basically half of what they were in the summer of 2011. And you'd say, well, okay, on that basis, Spain must be doing much better. Italy must be doing that much better. But, fiscally, they're a disaster. Italy, it took them forever to figure out who's even going to run the country, let alone fix the deficit. Spain, you've got unemployment peaking above 27%, with youth unemployment well above 50%. And again, the bond yields would say all is well. There's no problems here. And really, what you have, again, is a manipulated rate. Suppressed rates in Europe, suppressed rates in the U.S., as a consequence of money printing. Some of the most recent statistics showed a tremendous amount of traffic from the Japanese market into French bonds and Spanish and Italian bonds to a lesser degree, but French bonds as well. This is money that's been used to 0%, now is worried about getting chewed up and spit out because the yen is being devalued aggressively, and they're suppressing yields in Spain and Italy. Not a reflection of the real health or well-being of those countries. So, what do we have with interest rates? I think it's a diversionary story in the sense that it implies that there's no risk. You look at treasuries today; it implies that we have a healthy fiscal position, and we don't. So, what they're going to do is sacrifice the currency to try to keep things going. That's $85 billion a month for us, $76 billion a month for the Japanese. Let's let money over the Bank of England get his feet wet, get used to the new position there. He just moved over from Canada, and see what he does. He's sort of known for out-of-the-box thinking. Well, out-of-the-box thinking is what kind of got us into a mess. I'm not sure that more out-of-the-box thinking is going to really help us. More different ways of slicing and dicing a currency for the individual investor, it's ultimately dangerous, very dangerous. I would look for this theme of competitive currency devaluation to continue, to speed up, and ultimately for that to be reflected in the price of gold. Not gold as we've known it moving down in price, but moving considerably higher.
And you led me right to my next question, which is precious metals. And obviously there's been a lot of downward momentum recently. It looks like gold and silver may retest their lows. But David, the sentiment in these markets is just overwhelmingly negative. And I just wonder, at some point, might we see kind of a V-shaped rebound in case buyers come in and kind of overwhelm all these short sellers? Or is it possible that we have to await a fundamental catalyst before these metals can sustain a rebound and get back into bull territory?
Well, yeah, I think we've got plenty of fundamental catalysts already. It's just a question of whether or not anyone wants to acknowledge them or look at them differently. This is just a perception issue. You take inflation today in the United States. It's 2% officially. CPI is roughly 2%. They're talking about changing the model that they use to calculate it, which would make it, instead of 2%, 1.6%. Looking at the numbers as they stand today, if you use the model that Paul Volcker used in the 80s, we're already at 10%. So what is the number? Is it 2? Is it 1.6? Is it the 1990s model of close to 5%? Is the 1980s model of close to 10%? Today no one's concerned about inflation because people have confidence in the statisticians who are putting these numbers together. You've had the same degree of confidence in Arthur Andersen before sort of the whole blow up with Enron and all of that. The question was, can you rely on these numbers? And the answer is today, yes, you can. At least that's the way the market feels today. That's why I say this boils down to something that's sort of squishy. When do people get concerned about inflation? When they wake up. when they start connecting what is a gut level instinct that says, gosh, everything's more expensive today than it was last year or 10 years ago, and my real income is actually about where it was in 1995. I'm having a hard time paying bills. This has got to be so much balderdash. 1.6%, that's a game. So all that to say, Jordan, we already have the fundamentals in place. I think this is a lot like 1976 or even 2008. Sentiment was perfect. Sentiment was perfect for a turn, because really what you need to do is run out of sellers for a market to move higher. And we've got sellers. They've been selling out of the ETFs, they've been selling futures positions, and at the same time you've had slightly less buyers taking off of the physical market. We've been in the physical metals market since 1972. We still, whether it's this week, last week, even the week where we saw that better than 200-point decline in gold, saw purchases exceed liquidations on a 5-to-1 basis, if not a 10-to-1 basis. The purchases were off the charts relative to the liquidations. The weakness is with very weak hands, people who don't understand the fundamentals, who don't see a macro picture, which is very supportive to owning gold and silver, and frankly, somewhat negative for owning equities in general and bonds in particular. So all of these things are floating around, and just like 2008, when the financial media was saying, listen, there just is no reason to own gold, 1976 was the same. Whether it was the New York Times or Time Magazine, the media, the news media, was harping on the fact that there was no reason to own the metals. Inflation was a non-issue. This was 1976. Inflation is a non-issue. This is from Time Magazine. The dollar has completely stabilized. We have a growing economy. And yet, we know how the story finished, right? But the perception that people had was dead wrong. Their judgment of the macro picture was dead wrong. Their negativism on gold was dead wrong. And that's why I describe this sentiment as a perfect, I love it. I mean, this is, again, going back to your word, contrarian. As a contrarian, sentiment picture today could not be better. Could not be better because it's so bad. It doesn't get any worse than this in terms of sentiment. And so, I'm very eager to see as we head into 2014 where we go, because it's not like Citi Research is saying somewhere below $1,000 an ounce, somewhere below that 800 level. That's what Citi Research is saying today. The same researchers who were calling for $2,500 gold at $1,900 gold. So what we have is an exaggeration of emotion and a sense that somehow the charts in the short frame can be extrapolated upon, and what we've had in the last few weeks or months is exactly what we're going to have over the next few weeks or months. You'd like to think that analysts are a little bit smarter than that, but actually they're not. They're making some very, very significant but simple mistakes.
Okay, David, well, before we close, is there anything you want to comment on that we haven't covered here today?
Well, I mean, I think just a general recommendation. Yes, you need to have a strong cash position today. Yes, and for someone who's interested in gold, that may sound almost anathema. But balancing between, and that goes back to that earlier comment of, with certainty, you would have all of your money in one thing or the other. And right now, you've got the whole world with certainty, and that's why they're buying the S&P, buying the Dow, with a dividend yield of less than 2.5%, which historically has been the recipe for disaster. So you've got the market moving in one direction with great certainty. I would suggest that you live with a degree of uncertainty. Deal with the fact that you've got the combined inklings of both hyperinflation on the one hand, hyperdeflation on the other, and you need to have a strong position in cash. You need to have a strong position in gold and silver. Over the next 3 years, I think silver will outperform gold. That doesn't mean that it's going to do anything spectacular this year, but yes, it'll outperform. Those ratios are very compelling. And, I think that you're probably a little early to be picking up the miners. But over the next 3 to 6 to 12 months, you may be in a place where those are capitulating, in which case you'll be very grateful that you've got some liquidity and can add to existing positions or initiate new ones. This is a fabulous time to be around, Jordan. This is a fabulous time to be deploying capital, and quite exciting. But you do have to keep your wits about you. Thinking like a contrarian, I think, will pay handsomely over the next 2, 3, 4 years. don't be suckered in by the current emotions, which are unbelievably bullish for the stock market, unbelievably bearish for gold, and the fundamentals are actually lining up the exact opposite. You should be liquidating equities and moving towards metals, in my opinion.
Okay, David, well, before we go, why don't you tell our audience about the work you do at McAlvany Financial and where they can find you on the web and contact you?
The best place to find us is at McAlvany.com. It's McAlvany.com. And a great way to get to know us, this last year we put out a 3-part video series called The Fuse is Lit. We looked at Asia, China specifically. We looked at Europe, and we looked at the United States. The third part on America was called An American Reckoning, and spent some time looking at the fundamentals that we need to address to get this ship turned around. So that would be a great way to get to know us. Who are we? What do we do? We've been in the precious metals business, the hard asset business for 42 years, and the money management business as well. So we are sort of the best of sort of offensive coordinators and defensive coordinators, managing assets, regardless of what team needs to be on the field. So McAlvany.com is the best place to find us, and those videos are probably the best way to get to know us.
Okay, David. Well, thanks so much for your time today. I really appreciate it. Look forward to speaking to you again in the future.
Thank you, Jordan. Look forward to it.